How to understand the 1% rule for real estate investing, and what does that mean for your passive income every month? That's today's show. Let's get to it. Hey everyone, I'm Clayton Morris. Welcome to the Investing in Real Estate show. This is the show where we focus on building passive income, and how we do that is with buy and hold real estate. We find great real estate that's going to give us an enormous return on investment year after year after year, and the idea is that we hold it for the rest of our lives. That's what we focus on this channel specifically. So if you're looking for other real estate talk, if you want to learn about mobile home investing and giant commercial properties and investing in REITs, REITs, and all that other kind of stuff, or if you're interested in flipping houses, that's not what you're going to find here. We want to hold on to real estate in order to create great cash flow and increase our net worth for the rest of our lives. Today, I want to talk about a strategy that I know it's something that my father-in-law uses to great effect, and a lot of real estate investors use this as the standard by which they invest in real estate, and that is the 1% rule. So I want to dive into this today and help you understand a little bit about what this exactly means and what the 1% rule is. Now, let me preface this by saying that you should never use this as the entire metric for your investing strategy. So what I mean by that is, yes, it's a good way to kind of kickstart an idea and look in and say to yourself, okay, that sounds like it's going to be a good deal. Let me dive deeper. So you only want to really use this as a jumping off point in which to sort of figure out your real estate investing journey. You don't want to just say, yep, that's it. I'll buy that property, sold, after you understand the 1% rule. Again, it's just a jumping off place. So let's dive into it. What exactly is the 1% rule? Well, at the basic level, it just means that when you purchase a rental property or you purchase a piece of real estate, that it should cash flow every month 1%, up to 1% of the purchase price of that property. Now, in round numbers, let's make it super simple. So let's take, for instance, $100,000 property. When you look at a $100,000 property, that's the purchase price. What are you going to get? Get out your handy little calculator. Anyone help me with the math real quick? Ding, ding, ding. It's going to be $1,000 a month. So the 1% rule on a property of $100,000 in cost is $1,000 a month. That's what it needs to cash flow in order for you to basically kind of break even and make sure that your investment isn't a bust. Now, I know that many people use this to decide whether or not they're going to invest in real estate. You may use this as your baseline metric, deciding whether or not a deal is good or not. I'd like to go a little higher than that, but that's because I'm going after cash flow. But for a lot of investors, 1% is exactly where they want to be. I've heard it on podcasts. I've seen it from real estate experts who I've witnessed. I've been sitting in the audience listening to them, and these are millionaires, right, who own lots of properties around the world. They follow the 1% rule to make sure that their property is going to cash flow 1% of the purchase price of that property. So you can use that in your arsenal when you're deciding whether or not to buy a rental property, the 1% rule. Now, in terms of feasibility, this is my process when sort of analyzing a set of properties. What you want to look at, though, is not just the 1%. So if it doesn't meet that 1% rule, then I'm not going to buy it. I'm going to walk away. Now, a lot of investors I speak to, you own a rental property that maybe you had in the family, you lived in that property, and then you moved to another property and you kept it. I'm sure there's probably a lot of you listening right now raising your hand saying, yep, that's me. I have this townhouse that my wife and I had as our first property, and we moved and we kept it. And I'll ask them, what is the return on investment? And very often they can't answer that. Well, is it even hitting the 1% rule? So you bought it for $100,000 or you bought it for $80,000. It's paid off, great, and it's only cash flowing maybe $100 above what you owe on it, or maybe you have to take in your expenses and your taxes and all of the other things that you're paying. Don't forget to include your homeowners association. So if you've got a townhome or a condo, your HOA is going to eat into that 1% rule. That's why again, the 1% is just a jumping off point. When you want to take it a step further and start to analyze that property and really get into the nitty gritty, we need to look at taxes, we need to look at the HOA, we need to look at your insurance costs as well, and your property management costs. So all of those things need to be figured out before you just raise your hand and say, yep, I want to keep that property. So if it does meet that 1% rule, so when you're quickly analyzing a property, if it does meet that 1% rule, great, then move on from there and run the numbers on the property. I want you to start to check out what that cash flow will look like once you start to add in things like insurance and property taxes and things like that. So again, the 1% rule can be a really valuable mechanism to help you figure out, just sort of as a back of the envelope, quick calculation, is this property going to work for me? I'm telling you, though, if it doesn't, if, for instance, on that $100,000 property, it's only going to cash flow $800 a month, walk away. Run for the hills. Because guess what? When we start adding in taxes, when we start adding in other factors, repairs, property management, who knows what else you're going to be adding into that property, then it's going to start to dwindle it down to zero, next to nothing. At least with a 1% buffer, you know that you're probably going to be coming out on top, and then you can analyze the deal from there. Some investors like to go up to 2%. Now, if you go up to 2%, chances are you're going to have a lot of other things to experience. You're going to have a lot of other things to fix up. Now, typically, it's going to be on properties that are a little bit less expensive, like the ones that I like to buy. So you get properties, in the $40,000, $50,000 range. Well, yes, you're going to probably have to put $20,000 into them, and that's what I do. So $15,000, $20,000 of fixing up, and then the total cost is $50,000, $45,000. So I might, acquire the property for $25,000, and then I've got to put $20,000, $25,000 into it. So, okay, great. Now, can I hit the 2% rule? Meaning, will the monthly rent be about 2% of the purchase price of the property? And then you kind of move into those higher territory numbers. These are incredibly difficult to find, these types of properties, and you've got to have a lot of smart pieces in place in order to make a 2% rule work for you. We try to do that on every property that I do, but it's incredibly difficult. And by the way, these properties are very hard to find, especially in the good neighborhoods where you're going to have stable tenants, good job growth, and you're not going to have any headaches to worry about. You're not buying them in a war zone, right? Yeah, you can go. I had somebody email me the other day and say, hey, I found a $3,000 property. He was on some college campus somewhere. I don't know what state, and he just wanted some advice. And I said, well, I need some more details than that, right? If it's $3,000 and it's been sitting there on the market for a long time and it's been kind of publicly seen by people, chances are that thing should just be torn down. I mean, $3,000, what are you paying for? Really, probably just the value of the land at that point. So yeah, that may sound like a great deal, but then when you realize you've got to put $50,000 into the house because all it is a bombed out fire shell of a house. I mean, there are houses in New Jersey near my house that I've seen that are literally shells. They're shells. They've burned inside, and it's like a candy shell. You might as well just knock the whole thing down because it's worthless. So, when you're looking at those numbers, yes, you can find 2% properties. They're very hard to find, and they require a lot of work, and they require a lot of education in order to make them get you that type of cash flow. So, if you're at 1%, good. If you can be at a 1.5%, great. 2%, yes, that's great, but you really have to take into consideration a lot of factors. Again, these are just rules of thumb. These are good jumping off places, and it's a good way for you to kind of quickly do a quick analysis. When someone throws you a property and says, hey, I've got a property for $150,000, it cash flows $1,000. I'm going to throw that out to you right now. Is that a good one? Here's the property. You're going to buy it for $150,000. It's going to cash flow $1,000 a month. Ding, 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 ding. No, I'd walk away from that in a heartbeat. I'm not, $150,000 house that's only going to cash flow $1,000. No, thank you. I'd rather buy 3 properties. They're going to cash flow, $700, $800 a month, and I'll nearly triple that amount of cash flow. So again, just a quick back of the book analysis. Then it enables you to dive in a little bit more deeply and do some deeper research about the cash flow, about the history of the property, the homeowners association, if there is one. My feelings on homeowners associations. I've got a whole series on why I don't like condos and townhomes and those types of things, because those special assessments by the condo association can come out of the blue and charge you, an additional $2,000 to fix the roof on the whole complex, which happened to me. So I'm not a big fan of those. But again, that is the 1% rule. It's a tool that a lot of investors use to great effect in order to buy a rental property. I know my father-in-law did it, and when he found out that he could get great deals at 1% or above, he was able to jump on those deals and invest quickly. So it's a tool in your arsenal in order to help you invest in rental properties quickly. I hope you found this useful. These are things that we don't learn right away when we're investing in real estate, but once you understand the things like 1% rule, then it's always something you can keep in your pocket, in your purse, in your wallet, that you can pull out in a moment's notice in order to analyze a deal and then take it from there. I hope you found this helpful. I know I found this helpful when I was first starting in real estate investing. If you have any questions, I would love to hear your thoughts. If you're watching this on video, please leave some comments in the thread below and ask any questions. We always respond. I try to respond very, very quickly to questions. And thank you so much for subscribing and leaving all of your kind reviews as well. I really, really appreciate it. We publish this show multiple times per week, everyone. We really try to help you go out there, become a real estate investor. We really want you to take action and to build legacy wealth for you and your family. We want you to have all the tools here in order to do that. Much love to you all. We'll see you next time here on the Investing in Real Estate Show. Bye, everyone.